Have you ever wondered how governments manage the economic performance of an entire country? It's quite the riddle, isn't it? Well, the answer lies in macroeconomic policy. This is the strategy used to juggle a nation's economy with the goal of maintaining stable growth and limiting fluctuations. Intriguingly, there are two major types of these policies: fiscal and monetary. Fiscal policy involves government spending and taxation, while monetary policy concerns money supply and central banking. Now let's dig deeper into these two types of macroeconomic policies. Imagine a country in a recession. People are out of work, businesses are shutting down. What can the government do? Enter fiscal policy, the government's method of regulating the economy through its powers over taxation and spending. Picture this. The government decides to decrease taxes and increase spending. This puts more money into the hands of consumers, encouraging them to spend more. Businesses see increased demand, leading to more production and, consequently, more employment. But there's more to it. The multiplier effect comes into play. This is the idea that an initial change in spending can lead to a larger change in economic output. The money spent by the government circulates through the economy, leading to even more spending and economic activity. So that's how a government can use fiscal policy to jumpstart a slowing economy. But what about the other tool in the macroeconomic policy toolbox? You've probably heard of central banks, but do you know what they do? They're like the puppeteers of an economy, pulling the strings of monetary policy to stimulate or cool economic activity. Let's consider an example. Imagine a central bank wants to stimulate economic activity. It could increase the money supply, which typically leads to lower interest rates. With lower interest rates, businesses are more likely to borrow and invest, and consumers are more likely to spend, spurring economic activity. Now, how does a central bank increase the money supply? One way is through open market operations, where they buy government bonds, thus injecting money into the economy. Another tool is changing reserve requirements, the amount of cash banks must hold against deposits. Lowering this requirement allows banks to lend more, increasing the money supply. So now you know how monetary policy can also play a critical role in managing an economy. So we've covered a lot of ground today, haven't we? We've journeyed through the realms of fiscal and monetary policy, explored the terrain of government spending and taxation, and delved into the multiplier effect. We've also navigated the waters of money supply, central banking, and the tools of monetary policy, including open market operations and reserve requirements. Thanks for sticking with us through this whirlwind tour of macroeconomic policy. If you enjoyed this video, please give a thumbs up, subscribe, and suggest new topics. And remember, the economy might be complex, but understanding it doesn't have to be.